Hello friends, welcome to the March edition of Monthly Viewpoints. After a strong start to the year in Jan, global equity markets continued their positive momentum in Feb. Markets were supported by a decisively dovish Fed coupled with optimism on the US-China trade talks. Locally, however, markets were impacted by a mixed Q3 reporting season, concerns around some NBFCs, uncertainties regarding outcome of the general elections, and heightened geopolitical tensions between India and Pakistan. Starting with the global macro, the US economy cooled less than expected in the fourth quarter last year. However, GDP growth is expected to decline in the first quarter this year as consumption growth has started slowing down. With the world's major banks, including the US Fed, ECB, Bundesbank and the Bank of Japan becoming dovish, emerging markets now have space for policy easing, which would give a boost to their economies. On the trade war front, US President Trump has indicated that the US and China are very close to signing a new trade agreement following substantial progress in talks. This is positive for the global economy. Brent crude prices have rallied almost 23% in Jan-Feb 2019 after posting a 36% drop in the fourth quarter last year. This has been mainly due to supply cuts by the OPEC Plus coalition. However, crude prices are still within the expected range of $60 to $70 a barrel, which is manageable by emerging economies, including India. With crude prices as well as the rupee remaining range-bound, external stability is less of a concern right now. Considering these developments, emerging markets saw FPI inflows in the month of February, and India alone saw inflows of about $2.4 billion in equities. However, the MSCI has increased China's weight in the MSCI Emerging Markets Index by 90 basis points. This will potentially lead to a reduction of India's weightage by 75 basis points, which could impact FPI inflows in the months coming forward. Coming to the domestic markets, India's Q3 FY19 GDP growth moderated to 6.6%, mainly due to a decline in credit growth and disbursements as the risk aversion increased post the NBFC issues. However, this slowdown seems temporary as the liquidity situation is improving and demand is also expected to pick up due to the stimulus provided by the initiatives in the interim budget. The expected GDP growth for FY19 has been revised from 7.2% to 7%, mainly due to a decline in the government spending coming off of a high base. However, India is still expected to post robust GDP growth of 7.3 to 7.4% in FY20, driven mainly by domestic consumption. As per a recent report, India's consumption has grown at almost a 13% CAGR over the past decade to reach almost 110 trillion rupees. It is likely continue at around 12% CAGR over the next decade to reach around 330 trillion by 2028. The government's infusion of 48,000 crore rupees into the public sector banks that are still under the PCA framework should also aid credit growth. The government also recently reduced the GST on under construction properties, which will be positive for sentiment. The Q3 earnings season recently concluded and two-thirds of the Nifty 50 companies have come either above or in line versus estimates. Select private sector banks, corporate banks and NBFCs, IT, capital goods and infra, and some consumption-oriented companies have reported decent set of numbers. However, the Nifty EPS growth for FY19 and FY20 has been downgraded by around 3 to 5% because of earning downgrades in companies in the auto, cement and metal sectors. Coming to our view on the markets. While the large cap Nifty index was flat in Feb, we saw significant intra-month volatility with the Nifty moving almost plus or minus 5%. The mid-cap and the small-cap indices declined by 1 to 3% and continue to underperform the large-cap index. While global markets have seen a rally year-to-date, India has not participated in this rally, due to which India's outperformance versus the MSCI Emerging Markets Index seen in 2018 has been wiped out. However, after a strong response from the government to the cross-border terrorism, the market is factoring in higher chances of the current government coming back. Confidence is returning back to the markets, leading to the rally we saw in the mid-cap and small-cap stocks. We expect the market to pick up from here. Broader earnings growth for the market remains supportive. The Nifty is currently valued at 1-year forward P multiple of around 18x, which is a slight premium to the long-term average. However, valuations for the broader market have corrected and offered a good return to long-term investors. We remain constructive on India's economic growth going forward and hence would recommend that investors continue to build their equity exposure for the long term. Investors would also be better off doing SIPs and STPs over the next 6 months rather than lump sum investments. It would also be prudent for investors to allocate 20% of their corpus to mid-cap and small-cap funds as valuations in that space have become attractive. Select themes we are participating in include consumption, which includes the consumer and consumer discretionary sectors, and financials, which includes the private banks, corporate banks, and select NBFCs. We offer a basket of funds for investors to choose from. Thank you and happy investing.